Hi, I'm Jim Jubak, and welcome to my YouTube video for June 15th, Fed Wednesday. Please like this video and subscribe to my YouTube channel. If you want more of my stuff, go to my free site, jubakpicks.com. If you want even more portfolios, options, ETFs, you can go to my paid site, that's jubakam.com. The title of this is The Fed Hikes, the Market's Happy, and I think we need to understand why. Today, what the Fed did was raise interest rates, raise its short-term interest rate benchmark by 75 basis points. It's the biggest increase, biggest one-shot increase since 1994, and it takes rates to a range of 1.5 to 1.75 for the Fed funds rate. The Fed also came out today and said, hey, we think interest rates are going to go a little higher than we expected, and we're expecting that we'll finish the year around 3.4, which implies another 1.75 basis points increase. All the major indexes went up today. They were going up this morning. They went up more this afternoon. So let's look at a couple of them. This is the S&P 500. You can see it's had a plunge, and this is today's bounce. The NASDAQ looks much the same. Plunge and then a bounce even higher. We've had a slight preference for riskier assets today, so that the NASDAQ is up slightly more than the S&P. When I checked today at about 3:30, the S&P was up 2.26, the NASDAQ was up 3.37. But why, 75 basis points is more than we were all expecting a while ago. This plunge from here to here was sort of based on fear that the Fed would be raising rates more than expected. So what has turned around? Over the last week, we've seen a narrative fall into place, which I think explains today's happiness at the move. The narrative basically is this: the Fed is going to be more aggressive. It's going to raise interest rates by 75 basis points in June, 75 basis points in July, 75 basis points in September. And then it's pretty much done. And that's the good news. So basically the market has been saying, hey, we're going to get a lot of this done really fast, and then we'll go back to the Fed basically sitting on the sidelines. Maybe we'll get another 25 basis points in November, and that'll take us back to about 3.4% or so by the end of 2022. And that's what the Fed was saying in its dot plot released today. So that means basically that we'd be going into December with the Fed saying, hey, we're done. We're not going to raise rates anymore. And this fits into the second part of the narrative, which is that the Fed is going to sit there and, having conquered inflation with another 175 basis points in 2022, going to sit on its hands in the first half of 2023 and then go, oh my goodness, we've raised rates too far, and we'll actually cut rates at the end of 2023. This is the story. This is the narrative. And as Robert Shiller wrote in his most recent book, narratives drive the stock market. And this is the narrative, I think, that in the short term is driving this. Two things to consider. One is that this is a strong narrative with a lot of belief. If we get a 75 basis point interest rate increase in July, that will solidify this narrative. And I think that means that we're looking at probably a market that goes up a little bit, maybe more. If we then got 75 basis points of increase in September, that would pretty much lock in the narrative, and then we might get a nice rally. That's point one. Point two is, I think that this is a narrative based on very, very wishful thinking. I don't think there's any way that driving the short-term Fed funds rate up to 3.4 conquers inflation. There's just too much going on in the global and national economies to make that an effective end to inflation. So I think what we're looking at is that after this, the market then sits there and gets some more data and goes, oh, inflation isn't over. The Fed really isn't going to be able to sit on the sidelines. And this bear market that we're in right now will resume. It will probably never have actually stopped, but we're looking at, I think, is the possibility of a bear market rally and then more bear market in 2023. At least that's how I see it right now. The question is, of course, what kind of short-term rally we get. How strong is it going to be? We've had some pretty significant selling, so I assume that we should get a pretty decent bounce. The issue is not really what happens to a stock like Microsoft, which will go up maybe 1.5%, 1.6%, like it went up today last time I looked. But what we get some of the riskier issues. So that if we get, 7, 8, 9% jumps in, some of the meme stocks, in some of the more risky technology stocks, I think then we're looking at this rally having some legs, but I think it's still going to be a bear rally. So that's my take right now. If you like this video, please like it. Subscribe to my YouTube channel. That way you get a notification of what we're doing. And if you want more, including more takes on the market every day, go to my free site, that's jubakpicks.com. If you want 6 portfolios, including ETFs and what do you call them? Options. Go to my paid site, that's jubakam.com. Thanks very much for watching.